Hello everyone, good afternoon. Can you all please give me quick confirmation if I'm audible? All right. Good afternoon once again, everyone, and welcome to our SBR Grand Webinar Day 2 for June 2026 attempt. We have already finished Grand Webinar Day 1 yesterday, and I had picked up a pre-June 2026 mock paper. We had cracked question number 1, which was on groups, and question number 2, which was on ethics. Today, we'll continue with the same paper, the June pre-mock 2026, and we will take the question number 3, which is Wouri Company, and question number 4, Map Company. And these are going to be around other standards, remaining standards. Sometimes you will see a mix of few standards that is being tested here. One question from this has investor focus as well. So you're going to get good practice around amalgamation and investor focus. Okay. So I would want you all at this point to open your pre-June 2026 paper. Okay, and come to the navigator and come to question number 3. The mock is going to be mostly scheduled for your next weekend. So next weekend you have your grand revision, but you will also have in one of the weekends the paper, and the debrief will then be on the 23rd of May. That's how it's planned. All right. So I believe everybody is already on this question. So I'm going to start reading this now. Okay. The following exhibits available on the left-hand side of the screen provide information relevant to the question: debt versus equity, second Wouri and Shelby B shares. This information should be used to answer the question requirements within the response option provided. So I'm going to go to the first exhibit. But before I go to the first exhibit, I would want to read the requirement. A1, discuss the key classification differences between liabilities and equity under the IFRS accounting standards. Examples should be given to illustrate your answer. Second, explain the impact of the classification of a financial instrument as a liability or equity in the financial statements. Okay, so you have to give a key difference between the liability and the equity. Okay, and you have to be able to give the impact. If one instrument, let's say you classify it as a liability, what impact can it have on the financial statement, versus if you show it as a equity, what kind of impact? So if you're showing as a liability, you know that there's a loan element that you're going to show in the liability, in the balance sheet side, balance sheet liability side, which if you're doing an equity issue, that's not going to be the case. You know that in a loan element, you're going to have interest payments, so interest payable will come in the P&L, interest expense will be recorded, and a payable will also be recorded. That will not be the case if it's equity. So those kind of differences you have to highlight for requirement 2. Okay, for requirement 1, liability and equity, you have to give the clear distinction between these two categories. That is, when you issue an equity instrument for an issuer, basis what he will record in his books as an equity, and to the issuer, if he's going to issue any instrument, basis what he's going to record it as a liability. So there are some key features for equity and liability both. Again, if you may recall that for liability, you have to have a principal repayment. Okay, then there is a interest payment, there is a fixed redemption date, right? It's compulsory, it's obligation, it's mandatory, it's not at the discretion of the issuer. But in the case of equity, there is no redemption compulsory. It's a residual interest, right? That is, after you sell off all the assets and you pay off all the liabilities, whatever is the residual interest in the net assets, that is what is going to be given to the shareholders. The dividend payments are not obligatory in nature, meaning if they are at the discretion of the management. So there are some key features which will help the issuer identify that is this like a liability or is this like a equity. Because sometimes in contract, whatever is written, and so many times in the real world this will happen in the contract, whatever is written, you can't go by just the classification given in the contract. For example, a contract may call it as a bond and a liability in nature, but if you see the features of it, it is behaving exactly like an equity. Okay, you're going to make dividend payments, and the dividend payments are discretionary, management's choice, it's not compulsory. There is no obligation to make a payment of the amount. You can also pay back in shares, let's say. There are some features that will help you identify that it's not a liability. So anyway, we will crack A1, then we'll crack A2 on the impacts. Okay. Then there is a requirement B, which is asking discuss whether arrangements regarding B shares of each Wouri and Shelby should be treated as liability. So this is getting into the scenario part of it. So we'll have to come to this later. But first, the difference between equity and liability instruments and the impacts of these in financials. There is some exhibit on the debt versus equity. We would read that as well. Okay. The distinction between liabilities and equity play a significant role in how entities provide their information in the financial statements. There are growing number of financial instruments with the characteristics of equity, which can lead to inconsistent classification in financial reporting and have resulted in diverse accounting treatments, right? So maybe on paper they are looking like loan notes, probably, but their treatment should have been exactly like equity. The ISB decided that clearer principles are needed to help companies account for financial instruments they issue both now and as financial instruments continue to evolve. Okay, this is just a background, I would say, problem statement that they have given regarding the equity and liability, right? It's a problem statement, and that's why they're asking us to clearly give guidelines as to how to distinguish between the two. Okay, and then we are moving to the specific scenario of Worry and Shelby. So this we will not touch right now. First, we will start with, or maybe because this is all Word, it's not calculation. I might want to directly do it on our Word so that the sheet is very much shareable. Otherwise, I will have to share some screenshots. Wait, we will do this on the Word only. Okay, so I'm going to take a Word to solve this. We have, I think, requirement A1, right? So you know that the way we are going to do is we are going to copy the requirement so that we don't miss on anything. Unfortunately, what happens is when I'm going to use the word, I'm not going to be able to copy the requirement. Anyway, classification, discuss the key classification differences between liabilities and equities. Okay. Differences. I'm just writing a heading. Okay. I want you all to recall, and I want you all to recall which standard was around financial instruments, equity, and liability. Can you all give me in the chat box? Though I really don't have to quote the standards, and that doesn't like cut my marks if I don't quote it. But I just want you all to be able to recall this and tell me which standard in the chat box, which standard helped us make a distinction between equity and liability instruments. IFRS 9 financial instruments. But now, if you may recall, for financial instruments itself, there are multiple standards, right? So, which is the standard which is especially on presentation of financial instruments? That's absolutely correct. It's IS 32, which is on the presentation of financial instruments. So, the guidance of which would form an equity instrument and which would form a liability instrument, it's IS 32. Okay. Now, while discussing the question itself, I was giving you some key features of what is the difference between an equity and liability instrument. So I'm just going to quickly start drafting that, okay? As per IFRS. And this is generic, okay? As per IFRS, you know that most of the cases you're following a principle based approach rather than a rule based approach. Rule based approach is if this is so and so and so and so, you have to do this kind of accounting, okay? So, for example, if the contract says bond, okay, do the treatment of a bond. If the contract says equity, do the treatment of equity. But principle will be like, look at the essence of it, okay? Look at the essence of it, meaning, sorry, the more appropriate word here is substance over form, meaning, I'll just correct myself. In case of classifying between equity and liability instrument, maybe the contract on paper is saying that this is a bond, okay? So that's the legal form of it. That's the legal form of it. But substance will take precedence over form. Substance has more priority over form, meaning on paper, even if the word bond is written, but if the characteristics of that particular instrument is that it acts like an equity, okay, then you have to record it like an equity. So this you have to be able to tell. This you have to be able to tell. As per IFRS, accounting has to be done basis substance over form. This means that the characteristics of the instruments will have more importance in classification of whether it is an equity instrument or debt instrument or a liability instrument compared to its legal form. This means that the characteristics of the instrument which will have, okay. Now, as for IS 32, liability instrument will require obligation of payment in cash or any other financial asset. It will have an obligation attached to pay the principal amount and interest element. There will be a fixed term. There will be a term, or I would say there will be a redemption date on which the amount becomes payable by the issuing entity or the issuer. Because whoever is going to issue that liability, issue the loan notes, for that entity, there is a liability on a certain date to make the payment. So there'll be a redemption date on which the amount becomes payable by the issuer. Then what other feature can we think of? I think these are the key features. So there is a compulsory redemption. There will be a redemption date, or I would say there will be a compulsory redemption. To be done. Let me just put this in two sentences. There will be a compulsory redemption required by the issuer. There will also be a liquidation date or fixed repayment date or a pre-decided repayment date. Why do I say pre-decided repayment date? Why am I making this stand out? Because if you see in equity where we talk about shares, that's not the case, right? Only on the winding up of the company you make the payment. The unwinding cost of the liability, okay, that's when you, because of the effective yeah, but right now I'm trying to highlight something which as a feature will make it different from an equity. So unwinding might not be a feature. That's the way you treat it. Once you have decided it's a liability, and then if this payment is a future date amount, then you bring it to present value. That's the treatment of it, I think. I wouldn't say that's a feature of it. Okay, because without bringing it to present value, also it could still be a liability recorded in your books. Now, as far as equity is concerned, however, in case of equity instrument, there is no obligation to make a payment of a fixed amount. There is only on the winding up of the company, it is required that the equity shareholders get their share from the residual interest. This means only once all assets have been disposed and liabilities settled, the shareholders will be paid from the remaining net assets. There is no fixed date of redemption. Also, there is also the dividend payments are at the discretion of the management, and no fixed dividend payment is required. So, you know the three classic differences in the two: liability or a debt instrument, fixed principal and interest payment; equity, no fixed principal payment, only on the winding up in the residual. And the dividend is also at the discretion. These are the two classic features, I would say, that segregate the two: fixed redemption date, no fixed redemption date. Okay. Now let's read further as to what it wants from us. Examples should also be given to illustrate your answer. So you will have to give example because there'll be some mark locked for it, right? So in case of liability, I'll just give bonds, right? So example, bonds when issued by the issuing entity requires repayment of principal amount at the redemption date and fixed principal, fixed interest payments. And over here, example, ordinary shares. In case of ordinary shares, there is no obligation to pay back the nominal or market value of the share, nor there is any compulsion to make dividend payment. Dividend is paid at the discretion of the management. So yes, we've written enough to be able to grab the 3 mark in both the cases, because if I'm thinking it's a 6 mark, let's say for financial, the liability instrument, the debt instrument, let's say if they've kept 3 mark and then another 3 mark for the asset, we have clearly given the distinction, whatever points are there, and we have clearly given example also. Okay. Now, explain the impact of the classification of a financial instrument as a liability or equity in the financial statements. Okay. So this is also very scoring, I feel, because if you do equity, where all the impact will hit, if you do a liability treatment, where all the impact will hit, it's easy to think in the P&L and the balance sheet one by one, where will it go. To the issuing entity, whether the instrument is classified as a debt instrument or equity instrument will impact its line items in both profit and loss and balance sheet. In case of liability instrument, there will be interest expense being recorded in the profit and loss, lowering the profits. Also, there will be liability or loan element presented in the liability side of the balance sheet. This will impact the gearing position of the entity, where the liabilities will be higher than equity. This can also affect the debt covenant, if any. What do I mean by debt covenant, if any? So you know that the organizations will definitely have borrowed funds, right? And in those borrowed funds with the bank, there'll always be some uh I would say some binding, some promises with the bank that their level of debt is going to be so and so. It's not going to exceed by a certain limit, because if it does, then the risk for the bank, the lending institute, will increase. And if the risk for the bank increases, the interest rate will shoot up with that particular bank, right? It might not be fixed, it might be based on the risk. So such covenants can get breached, and because of that, the loan taking ability in the future and the existing loan will also suffer, right? So if you classify an instrument as a debt instrument, it has many impacts. Your profit will reduce in the P&L. In the balance sheet, your liability will increase, and because your liability will increase, your gearing ratio will increase, and gearing ratio can break certain debt covenant. Okay. Also, your current liabilities could increase, because when you do a loan, you will show a breakup between current and non-current liabilities. So your current ratio will be current as assets upon current liabilities. So your current ratio will spoil. There will also be an impact on current ratio, as the current liabilities, which will represent the installments payable within a year, will rise. If the issuing entity classifies the instrument as an equity rather than debt, then there will be no recording of interest as finance cost in P&L. This means profits in this case will be higher. If profits are higher, dividend payments will be higher. In case of equity, the dividend payments are reduced from retained earnings in the balance sheet. Therefore, RE will drop. Also, the proceeds will not be presented in the liability, but in the equity side. This will show a improved gearing ratio. However, to the investors, this can lead to dilution in ownership. So exactly what is the impact if it is shown as a liability and if it is shown as an equity, liability and then equity. It's only logical. If you don't panic and if you're able to manage your pool, then these questions seem very unique in nature. Like you don't see these questions getting tested, right? On the presentation of the classification of the equity, and these are unique. But if you think through it, like if you are able to maintain your cool and not panic by seeing such questions, then you know that the answer is right there and it's not that difficult. What did I write in the first requirement A1? Just the pure difference between equity and liability, which you would already know. It's just that you would have to think through it that, oh, in liability, there is an obligation of payment of principal, payment of interest. The redemption is a fixed date, and in equity these features are exactly not there. So if you are able to maintain that piece, then yes, you can. Okay, I'll just maintain the proceeds sentence again. Where did I write that? Oh, okay. So the last one. Also, the proceeds will not be presented in the liability, but in the equity side. Proceeds meaning the cash proceeds that you're getting. If you're going to issue an instrument which will help you get the cash proceeds, then where am I presenting the cash proceeds? Debit is the bank, the cash proceeds, the bank, okay, the proceeds. And credit is what? So also the proceeds will not be presented in the liability, but in the equity side. Because if you're going to issue ordinary shares or if you're going to issue something which is like shares in nature, ordinary shares in nature, then it will not touch the liability. It will touch the equity, the share capital, the share premium. Okay. And this will show improved gearing ratio. Improved gearing ratio. Why? Because gearing ratio is debt upon equity. So your debt being, let's say, 10 million and your equity numerator denominator will change, no? Because you're saying that I issued, let's say, okay, let me show you. I had my debt as 10 million and I had my equity as, let's say, 20 million. I got some cash proceeds because of some instrument that I issued, and I got, let's say, another 10 million. So, what will happen to my gearing if treated as, if proceeds treated as debt instrument? So, you know that for debt upon equity, let's say if I'm using this formula, debt upon equity formula, then it will become 10 plus 10 divided by 20, which means 100% gearing. Okay. Maybe you will break some debt covenants, right? Then if proceeds treated as equity instrument, same formula, debt upon equity if I'm using, then my numerator being 10, debt, equity will become 30, right? So it will definitely be 33% or something, right? 10 by 30, 10 by 30. 33%, perfect. So this is going to be 33%. So can you see the difference in the way you classify how your debt covenant can easily get breached? Here you probably could be very safe. Let's say debt covenants are, you should not, your gearing should not increase by 40%. So you're very safe. Here, of course, you must have really touched the danger zone here. So this is what it means. Carolina, is this clear? Perfect. So anyway, we are done with the requirement A2 as well. Classification of the financial instrument, how it will impact your financial statements. It was worth a 4 mark, and these are the easy 4 marks for me. Next, the next 10 mark. Discuss whether the arrangements regarding the B shares of each Wouri and Shelby should be treated as liabilities or equity in the financial statements of the respective issuing companies. Discuss whether the arrangements regarding the B shares, so there is a B class of shares, in each of the Wouri and Shelby should be treated as liabilities or equity. So we have to make the judgment. We already saw what are the parameters for classifying something as equity and for classifying something as liability. So we will get into this now. See, sometimes some questions like this might appear scary to you in the exam. And if it did appear, let's say this was a real exam question, this is a pre-mock right now, but let's say this was a real exam question and it appeared difficult, right? For you, because you were probably thinking this is not a question style that I've cracked earlier. What is the job at this point of time when you've seen when you've found something which is not of your comfort zone? Don't think that whatever marks are here to offer is for you. Don't think that you are trying to get a 6 on 6. See, if a question is difficult, keep your target as to if even if you can manage the 3 mark here. That's not a problem. If for a difficult question, if your target is even just 50%, you will decrease the pressure immediately. Discuss the key classification difference between liabilities and equity. If you're not able to think through the differences between the two, both up to 6 marks, but if you keep the pressure that, okay, you have to just think of something up to 3 marks, because will help you touch the pass mark, right? At least that much for every question, if you can manage, will help you touch the pass mark. So if you lower the pressure for difficult questions, just get the 3 mark. For sure, your panic will immediately reduce. Okay. Similarly, when the impact of financial instrument, whether debt or liability, was asked on financial statement, you might be like, oh, 4 mark. I don't know if I can get the 4 mark. Reduce the pressure. Just think if you can get at least the 2 mark here. Think of the impacts to get at least the 2 mark here. Your pressure will reduce. And trust me, you will write something more worth than 2 mark only if you reduce your pressure. You will write something more than 2 mark only. Okay. Now, anyway, let's come to the scenario. We have to identify. I'll just read the impact. Discuss whether the arrangement for each is a liability or a equity. Okay, for the shares B, whether it's liability or equity. The directors of Narmada, a listed company, are reviewing the financial statements of two entities, which are acquisition targets, Wouri and Shelby. They have asked for clarification on the treatment of the following financial instruments within the financial statements of the two entities. So Narmada company is looking to acquire either Wouri or Shelby. Now they are looking at their financial statements and asking for some justifications that why certain thing is treated in a certain way. Okay, that's it. This is what it's saying. Now, Wouri has two classes of shares, A and B. A shares are Wouri's ordinary shares and are correctly classified as equity. So A, you don't have to pass any judgment. As per the requirement, you have to pass judgment anyway for B. So A, they're saying is ordinary and correctly classified as equity. B shares are not mandatorily redeemable. Not mandatory redeemable. One of the features they have given. But contain a call option, allowing Wouri to repurchase them. So Wouri, who's the issuing entity of these shares, doesn't have to mandatorily redeem it, meaning doesn't have to there's no obligation to make a payment for these shares, but it has an option. It has an option to repurchase. Dividends are payable on the B shares if and only if dividends have been paid on the A ordinary shares. Okay. In which case you have to make a payment for B shares dividends only if you have made a dividend payment on A shares. The term of B shares are such that dividends are payable at the rate equal to that of the A ordinary shares. So as such, there is no obligation to make a dividend payment on the B shares. But if you have made a payment on A shares, dividend payment on A shares, then yes, you can make a dividend payment for B shares. But first, you have to make a payment dividend on A shares. And that is also not an obligation. If you don't make a payment of dividend on A shares, no need to pay for B shares. Not at all, rather, you should be doing it for B shares. Okay. But if you do it for A shares, then yes, you can make a dividend payment for B shares. Now, additionally, Wouri has also issued share options which give the counterparty rights to buy a fixed number of its B shares for a fixed amount of 10 million. The contract can be settled only by the issuance of shares for cash by Wouri Company. Then we are going to shall be company. So let's first observe this much, okay? Before additionally, I read what is an additionally. Before I read that, for whatever features are being highlighted, that it's not mandatory, but there is a call option available. Dividend payment is not mandatory, but if you make a payment for A, then you can make a dividend payment for B. When you read these features, what do you think? These B class of shares of Wouri Company, is it equity or is it a liability? Is it an equity or is it a liability? When you read these features, what do you think? Is it an equity or is it a liability? Guys, the B class of shares, I will highlight. The B class of shares, no redemption fixed. No redemption fixed. Second, there is a call option, meaning it's an option for the issuing entity whether it wants to do a buyback or not. Third, no mandatory dividend. Only if paid to A, then B you can. What do you think with these features? Is it a equity or a liability? Yes, it seems to be a equity because there is no obligation of payment, there is no fixed um, date, then there is no mandatory dividend payment. Only if you pay for A, then you have to pay for B. So if you don't want to pay for B, don't pay for A also, no need to pay for B also. So yes, that is the correct conclusion. The other issue that they're doing, okay, additionally, Wouri has also issued share options which give the counterparty rights to buy fixed number of B shares. Now, this is a share option. Now, you have to think about this share option. That is, this share option is giving a right to buy a fixed number of B shares, for a fixed amount of 10 million. And the contract can be settled only by the issuance of shares for cash by Wouri Company. So now what has happened is 10 million of amount, you are receiving 10 million of amount. Against this, you have to give fixed number of shares. Fixed number of shares. Now, this 10 million amount is fixed. The number of shares is also fixed. Two things are fixed over here. The amount is also fixed and the number of shares is also fixed. Okay? Which means that I'm going to get 10 million. Against that, I have, let's say, promised 10 million shares. Okay, because they have said it's fixed, but they did not reveal what number of shares is fixed. But for example, let's say 10 million fixed shares. Okay, but let's say if the market value of each share at that point of time is dollar 0.5, then in essence, you are actually giving something worth only a 5 million. Let's say if the market value for each share is 1.5, then you will, in essence, end up giving the opposite entity to the issuing entity, to the entity who has given the money, 15 million. So the risk is with whom? The risk is with the issuing entity or is it with the lender? Who is the risk with? Because if the number of shares is fixed, if the number of shares are fixed, then whatever be the market value, that much is only what you will end up shelling out. So is the risk with the issuing entity or is the risk with the lending entity? Carolina is saying is with the issuing entity. I want everyone to think about this. Okay, I want everyone to think about this, that if I have borrowed 10 million and against that I'm saying I'm going to give fixed 10 million shares, whatever be the market rate, whatever be the market rate. If the market rate is $0.5, I end up giving only 5 million. Meaning, in essence, it's just a 5 million transaction. I'm giving shares, but the transaction worth is, it means it's 5 million. But let's say if the shares market value is going as it's 15 million. No, guys, it's not actually issuing entity. It's actually the lending entity. I'll tell you why. I'll tell you why. See, 10 million the lending entity paid. 10 million the lending entity gave. Okay. Now the lending entity can get 5 million also, can get 15 million also. So risk and reward is being enjoyed by the lending entity. Risks and reward are being enjoyed by the lending entity. The risk is with the lending entity. That if the share value is less, then they will get 5 million only for 10 million that they had lended. Okay. If if it was not a fixed number of shares, if it was not a fixed, I'll tell you what the other arrangement can be. Okay, I'll just show you here itself what the other arrangement can be. This is arrangement A. Okay, for example, now I'm showing you arrangement B, what arrangement B can be. For 10 million of an amount that I have gotten, I am saying I will give shares worth 10 million. Worth is 10 million. So if I'm fixing this amount, that okay, if I'm getting 10 million, I am going to pay 10 million, then is this not acting like a liability in nature? That for sure, how much I borrowed, I'm going to make good of up to that amount. For sure, how much I've borrowed, I'm going to make good up to that amount. In case of equity, what happens? You don't have to have such kind of promise. If you remember the ordinary shares, the way it behaved, it is the interest in the residual interest. Whatever was invested, you can't or you don't rather promise that kind of redemption amount. Whatever is the residual interest, that much only. Here also, if you see, whatever was borrowed by you, by the issuing entity, the repayment part of it is not guaranteed. Whatever is the share price, that much the opposite entity will be able to enjoy. So this is behaving like an equity. This arrangement will behave like an equity where you're fixing the number of shares, But if you will end up fixing the number of amount, if you will end up fixing the amount against what amount you got. If you got 10 million and you will fix up that, okay, you have to make a 10 million payment. So the shares can be now anything. Now, if let's say if each share is worth 1 million, then you will end up giving 10 million shares. But let's say if each share is worth $2, then you will end up giving only 5 million shares. So your repayment in shares now will fluctuate. Either you'll give 10 million shares or 5 million shares, depending upon the share value. So if there is a variability in the share payment, but the amount that you have to repay is fixed, amount that you will have to repay is fixed because you got 10 million, this will act like a liability in nature. So I am now asking about the share options. What we concluded is already for the class of shares, class of B shares. Class of B shares, when you look at it, yes, they seem to be like an equity only because there is no obligation on the principal and all of that. But what about these option shares? Do they appear like a liability or an equity? Now, basis what I explained right now, you all need to tell me that does this appear like a liability or does this appear like an equity? Does this appear like a liability or does this appear like an equity? Think about it again. Look at the words, look at the keywords, guys. It's saying share options which give the counterparty rights to buy fixed number of B shares. The number of shares are fixed. Amount is not fixed. If number of shares are fixed, okay, then whatever is the share price, you're only returning that much. You're not guaranteeing that certain principal amount is going to be repaid. Amount of 10 million, when you took that much, but repaying amount is not fixed, no? You're fixing the number of shares. You're not fixing the amount that you're going to repay. You're just fixing the number of shares. So it's an equity in nature. Now, when I draft the answer, it will just get better. Okay, when I draft the answer, it will get better. Wouri Company has issued Class B shares which are not mandatorily redeemable. However, if Wouri wants, it can purchase the shares as it has a call option. This is at the discretion of Wouri without any obligation of the same. Secondly, in case of dividend payment, also it has no obligation to make dividend payment for option for Class B shares. If it decides to make a payment for Class A shares, then it can pay for Class B shares of the same amount that was paid for Class A. Therefore, this dividend is avoidable and will be paid only on management's discretion. Both these features highlight that Class B shares are equity in nature and not liability due to absence of any obligation to make principal or dividend payments. In case of the share options issued of 10 million, for a fixed amount of 10 million, we can see that Class B shares will be issued, which will also be fixed in number. Therefore, irrespective of what is the market price of the shares, only the agreed amount of shares will be given to the lending party. This means that the risk, this means that this behaves like an equity as the principal repayment is not guaranteed like an equity and will depend upon market condition. Okay. Okay, Darshini, what are you asking? How is that possible that the number of share is also fixed and the amount is also fixed when the market price is different? See, Darshini, this is gamble, right? Like the entity which is going to lend money is agreeing that for 10 million of what I'm going to give to you, in return, I want 10 million shares or 20 million shares or 30 million shares. They're fixing it into a contract. Those are terms and conditions can be anything that the two parties agreeing to. So if the lending party is agreeing that for 10 million shares, for 10 million amount, I would want in the future 10 million shares only, then it means that that entity is ready to bear a certain level of risk that it might not get its principal payment even back, or it might get more than principal payment back, right? So it's not like a true liability where you're guaranteed a principal payment plus some interest on it, right? It's not like that. You are going to play with the risk of uncertainty. So that's why, one, the situation is possible, and this is how the treatment will be. Now I'm going to go to Shelby Company. So it's saying Shelby has an issue two classes of shares, A and B. A shares are correctly classified as equity. One minute, did I conclude it or not? Okay, I concluded it. Yeah, Shelby has an issue two class of shares, A and B. A shares are correctly classified as equity. 2 million B shares of nominal $1 each are in issue. The B shares are redeemable in 2 years' time at the option of Shelby. Shelby has a choice of method to redeem the B shares. It may either redeem the B shares for cash at their nominal value, or it may issue 1 million A shares in settlement. A shares are true equity in nature. Okay. A shares are currently valued at 10 per share. The lowest price of Shelby's A share since its formation has been 5 per share. Sorry. when the when the shares are fixed, it's the number of shares are fixed, it's not a liability. But when the amount is fixed, it will be a liability, Darshini. Yes, if the amount is fixed that you're going to pay, but the shares are not fixed, then yes, it will act like a liability. Because what happens in loan, when you're going to borrow a sum, you have to pay that amount. No lender is going to give you that money without having that kind of security that he's going to get his principal payment back, right? No lender is going to do. So for you, that's like a loan element, right? That is loan where you have to give a guaranteed amount payment, guaranteed amount back. In case of equity, that is not the case. The party who is lending you the money, who are the shareholders, you don't have to guarantee them any amount. You don't have to guarantee them any amount. It is basis the residual, what is remaining in the company or the way the market is behaving. So that amount is not guaranteed, is why it does not act like a liability. Carolina, what it says is a fixed amount of 10 million is what you're getting, but the repayment of what you're doing is not a 10 million. No? Against that 10 million, you're not making a fixed 10 million repayment. What you're doing is a fixed share payment. The amount of shares, or sorry, the number of shares is fixed. So the number of shares, when you convert it to amount, it can be anything based on the market price. It can be 2 million, 3 million, 4 million, 5 million. It's not fixed. So it's not acting like a loan. Because in loan, that is a guarantee that, okay, you're going to give this principal payment back, right? There is that guarantee there. And here, this guarantee seems to be missing. Darshini, did you understand? Carolina, did you understand? The amount that you're getting is fixed, but the amount that you're repaying is not fixed. Carolina, yes or no? Did you understand? If you're still confused, I'll demonstrate accordingly. Please give me clarity whether you're okay or you're still confused. Okay, I'll explain again. I think you'll have, because yes, it's fairly like a, surprise element that's got tested. So no problem. I'll repeat, okay? $10 million cash proceeds you're receiving. This is fixed. You're getting this much, right? This is fixed. But your repayment is fixed in number of shares. Therefore, sorry. So it got fixed at, that is, let's say, because I have to give an example of what number of shares got fixed. Here, they did not reveal the number of shares fixed. So example, I'll continue that. Let's say if they had revealed it, what number of shares were fixed. So number of shares fixed was, let's say, 10 million only. For 10 million cash, 10 million shares. So at the repayment date, if market price is $2, the entity will get 20 million. Okay. The lending entity is getting 20 million. But if market price is $1, it's getting 10 million. But if market price is $5, it's going to get a 0.5 million. You, the issuing entity who issued this and who got these funds, like a loan, do you have an obligation to make good of this 10 million? Like a loan, do you have, when you see the outputs, is there an obligation of like that you have to for sure make a repayment of 10 million when you look at the output? It could be 5.5 million, it could be 10, it could be 20. You're giving shares, the shares worth could be 0.5, could be 10, could be 20. Is there a guaranteed amount? No. So if there is no guaranteed amount, does the loan behave like that? In loan, do you not guarantee that the principal payment will be paid back to the lender? Do you not guarantee yes or no? In loan, do you guarantee yes or no? Yes, it is guaranteed, right? So in this case, when we talk about fixing the number of shares, when we talk about fixing the number of shares, then in that case, this will behave like a equity instrument. Why? Because the nature is not like loan where you're guaranteeing a fixed amount to be paid. Okay. Now, I will I will give you another scenario where it will behave like a loan now. Okay. So this behave like an equity concluded. Okay. Same like when you issue shares, you know that the residual interest is what you are supposed to give to the shareholders back. It's not a guaranteed amount. That residual interest can be very high, can be very low, can be up to the nominal value where these guys invested. It can be anything. It's not guaranteed, right? Now, in case of when it will behave like a loan, okay? Now let me paint these. This was scenario A. Now let me paint scenario B for you all. 10 million cash receipts received. This is a fixed amount that you received. Repayment is in shares worth 10 million. You're fixing the amount itself that you will pay whatever the number of shares, 100 million shares, 200 million shares, 600 million shares, 1 million share, 500,000 shares, 10,000 shares, or just 5 shares. But those 5 shares should be worth 10 million. Or if you require 10,000 shares to make that 10 million, 10,000 shares. If you like require 100 million shares to make that 10 million, then 100 million shares. The shares amount, number of shares is not fixed. Amount is fixed. In loan, that's how it behaves, that you have to guarantee the repayment of that principal amount, right? So in this case, it will act. Okay, so in this case, okay, in this case, second case is going to act like a loan. So now who had asked me, Carolina and Darshini, did you understand the difference? Okay, how can you identify in this question? Okay, fine, great. I'll show you now how to identify the question. Additionally, Wouri has also issued share options which give the counterparties rights to buy fixed number of B shares for a fixed amount of 10 million. The fixed amount of 10 million is what you're receiving, not what you're going to pay back. This is what you're receiving. So against this 10 million, you are going to pay a fixed number of B shares. That's going to be pre-decided. This fixed number, this is helping us identify. Is this clear, dear? Carolina, Darshini, is this clear? Perfect, perfect. Okay. Now, let's move to Shelby, okay? Now, what was happening in Shelby? I think we already read the scenario and I think I was just drafting for Shelby, right? But I think we lost track, so we'll read it quickly again. Now, what happened with Shelby? Shelby has an issue two classes, again A and B. A are correctly classified as equity. 2 million B shares of nominal value of $1 each are in issue. Okay, right now they're saying are in issue. They did not share the characteristics. Now they'll share the characteristics. The B shares are redeemable in 2 years' time. In 2 years' time, they're redeemable in 2 years' time at the option of Shelby. Now, be very careful. It's not that the option of redeeming is in Shelby's hand. Something else is in Shelby's hand. The way it wants to redeem, but it has to redeem in 2 years' time. Okay, the way it can redeem is optional, but it has to redeem in 2 years' time. This is guaranteed. So one feature identified. Now, Shelby has a choice of method to redeem the B shares. This is the option. Okay, Shelby has a choice to method to redeem the B shares. It may either redeem the B shares for a cash at their nominal value, or it may issue 1 million A shares in settlement. Okay. Now, again, you can see 1 million A shares it can issue in settlement. Now, again, the shares are fixed. The repayment is fixed in shares. So if the repayment is fixed in number of shares, if not amount, what did we decide that what it is showing? What is the nature it is then? If the number of shares is fixed rather than the amount being fixed, then what did we say? What does it behave like? Debt or equity? If I'm going to pay 1 million A shares, the number of shares are fixed, then it's equity, right? But now let's look into it in detail. Okay? Now, A shares are currently valued at $10 per share. The lowest price for Shelby's A shares since formation has been $5. Now, two options identified. Okay, it can pay in two ways. Option A is it took 2 million shares, so it is going to make a cash payment for the nominal value. Okay, for whatever is the nominal value. So it may either redeem the B shares for cash at their nominal value, or okay. So if nominal value is what? It's at $1 each. So meaning if you got $2 million, okay, first of all, let me put it in this fashion. Okay, what you got is fixed. You got $2 million. This is what you got fixed. Now, against this, you have option A that you will pay cash also of $2 million. This is again a fixed amount because you're saying you'll pay nominal and these are $1. Okay. The other option is you will pay in the form of A shares. You will pay in the form of A shares and the A shares are fixed at 1 million. 1 million shares. The shares are fixed in quantity. 1 million shares quantity is fixed. Now, whatever is the price of that shares, opposite party will get to enjoy that. Okay. So you're not fixing an amount, you're fixing the number of shares. Now, they have, by historical trend, they have told us that the market price per share has either been 10, is currently 10, or the lowest has been $5. So if you choose to pay in A, what in essence you are ending up giving is 1 million shares of $10 each, which will be 10 million. Or on the lower side, if we talk, it will be 1 million into $5, which is 5 million. Now, looking at the economic reality, Okay, you have this as an option, and this can be the case looking at the current scenario where market price is going on, and the lowest, if you turn it into shares, will be 5. Looking at the economic reality, will you ever choose option B, or you will go for option A only when the redemption will come? Will you ever choose option B, or you will always choose redemption? You will always choose option A only when the redemption will come. The issuing entity, you who is issuing, if you issue shares, sorry, if you pay back in shares, the worth of that shares is 10 million and 5 million. 10 million right now, but the average, the lowest, not even average, the lowest has been 5 million. So would you want to pay something which is worth more, or will you pay back the loan or pay back the amount that you've borrowed in something which is worth less? Will you give your most expensive thing, or will you give a cheaper thing to return the same loan? It's logical, guys. When you have taken a loan of 2 million, you have an option to repay in 2 million only, or you will give something more expensive. You will choose option A, right? You will give an asset which is worth, which is more cheap, right? So what can happen is organizations can make such contracts where they'll say, oh, you know what, we'll repay in either cash. So for 2 million, we'll either give a 2 million, or we can also pay in shares. And that shares, and the option is with the issuing entity. So issuing entity knows that never will it be the case that it will give shares, because the share prices is always high. They will always stick to cash payment. But they can form this contract to escape the route of showing something as a liability in their books. Because if you show something as a liability, it has many disadvantages, right? So you might simply add this clause, which is not even a reality, which will never be the reality. Okay? You might simply add this clause, which will never be the reality. Because let's say you have shares which is like crazy high in the market price. You will never pay back in that. You will never give such expensive instrument. You will never repay that amount that you've borrowed in such an expensive way. You will always say, take cash because it's my option. It's in my hand. Take cash and finish off the amount that I have borrowed. So simply the entities can attach this clause so that they can escape the loan presentation. Okay. So you have to check, in essence, even if this is given that, oh, you know what, the shares are fixed. The shares are fixed, which means it highlights towards equity, but B will never in reality be a practical option, or option that you will choose. So if this is an option that will never be chosen, then you are not allowed to show it as a equity instrument. You will have to stick to showing it as a loan instrument, because A option will be actually the economic reality. A option is something you will choose economically. So you will have to also show it like that. Did you all understand what I'm trying to explain over here? Yes or no? Did you all understand why option A, why not option B, and why A means why? I will show it like a loan. Okay, perfect. So yeah, in real, when this would have been tested in the exam, of course, this would have been difficult. You would have just tried to write something around it and move on from there. You wouldn't put so much effort, only the little bit that you can do by identifying the scenario. Okay, because like I said, you can't put yourself in so much pressure when there is a unique element that is getting tested, and this is clearly unique element, no? Okay, Tessin, when I'm forming the answer, no, this you will again understand, because it will be a revision, no? So you will understand. If still you don't understand, I'll explain why. Okay, okay. In case of Shelby, where it has issued Class B shares, the characteristics of this share of this share require requires a redemption after 2 years. However, the way it will be redeemed is at the discretion of Shelby. Shelby can choose to pay cash worth the nominal amount of the shares, which will amount to $2 million. 2 million shares multiplied by $1 for an amount of $2 million borrowed. The second option is to pay back in Class A shares of $1 of Class A shares of 1 million. We pay back in 1 million Class A shares. Considering the market value, if it had to pay in shares today, the shares would be worth $1 million into $10, so 5 million. Because I am paying in A shares, right? And A shares is fixed at 1 million shares. So I think in the example when I was doing above, I think I took it as 2 million, but that's for B shares that are in circulation at 2 million. When you pay for the B shares, which are 2 million in quantity, what you will pay back is only 1 million. So 1 million into $10 is 5 million. Or on the lower side, or historically, it has been observed that the lowest has been, market price has been $5, which will lead to shares being paid worth of sorry, I did a wrong calculation. 1 million, this is 10 million. No? Yeah, sorry. 1 million into $5, which is 5 million. In case of second option, considering the economic reality, Shelby will never pay in shares and will always choose to pay back using option 1. Therefore, even if second option appears to be like an equity, as the number of shares are fixed, but because it will never be a economical option, option 1 will be selected, which fixes the amount of principal that needs to be repaid. And therefore, this arrangement is liability and not equity. Okay, so I hope everyone has understood. Shall we? I'll just write over option 1 so it's more clear. And option 2. And then our conclusion. Okay, so I'm going to move now to the next bit of this. Discuss the accounting treatment applicable to investment in Kagera's consolidated financial statements for the year ended 31st December 2021 in accordance with IFRS accounting standards. Okay, let's read the scenario so that we can make sense of this question. What investment are they talking about? The treatment applicable to investment in Kagera. Okay, so let's see. Tehsin, did you understand when I was writing or forming the answer, or there is still a doubt that persists? Tehsin, is it clear? Great. Now let's come to Kagera. They want us to talk about how this Kagera is going to be treated, okay, as an investment. So on 31st December 20x1, is this the year end? Let me check first. So they did not mention the year end anywhere. Okay, they did not mention the year end anywhere. Anyway, let's read. On 31st December 20x1, Narmada acquired 75% controlling interest in a supplier, Kagera. The investment was intended to be short-term in nature, with Narmada management expecting to sell a 65% equity interest within 10 months of the acquisition, while retaining 10% NCI interest. Narmada has engaged advisors to commence an aggressive campaign to market for the sale of the controlling shareholding in Kagera in the first fortnight of the new financial year. Now think and tell me that when you talk about 75% interest in the entity, is 75% going to give control normally? Yes or no? Is 75% giving control? Yes or no? Does 75% give control? Yes or no? Yes, it does, right? If there is any other information which is not contradicting it, then yes, that 75% will give control. So for us, this is a subsidiary company. Okay, for us, this is a subsidiary company. As per IFRS 10, you will have to account for it as a subsidiary company. But there is another standard which says if subsidiary company is being bought with the exclusive intent of being sold, then which standard to apply? Exclusive intent of being sold, then which standard to apply? Then you have to apply on it IFRS 5, non-current assets held for sale and discontinued operations. What does IFRS 5 tell you? It doesn't stop you from recording it like a subsidiary, but then it tells you in a certain way you have to do the presentation. And what is that certain way in which you have to do the presentation? IFRS 5 will tell you a certain way in which you have to do the presentation and recognition of the assets and liabilities now of the subsidiary. It will want you to show it as in the P&L, it will be shown as a one line item as profits, profit or losses from so and so operation, because this operation is going to be sold off in the current year, right? So it's going to be shown separately. And in the balance sheet also, it's going to be as a one line called assets held for sale. So it's not going to be like that in the PP you have the assets for subsidiary, in the current assets you have, in the inventory you have. No, line by line item you're not doing. Only one line item called assets held for sale in the current assets, and liabilities held for disposal, also one line item in the liability side. So in this fashion, you will do the presentation. This is it. This is all you have to tell. That accounting is as per, yes, IFRS, consolidated financial statement. So you will do all your goodwill accounting and everything. But everything from a presentation perspective, IFRS 5 will take the lead then, because it's a subsidiary to be disposed of, bought with the exclusive idea of disposal. Sorry, guys, some internet connectivity issue. Anyway, we were on this entity proving that you should consolidate, but because IFRS 5 will take precedence, then you will do the presentation as per IFRS 5. Okay, as per IFRS, as more than 51% shares have been acquired with no information negating the control. 75%, 75%, right? Let me confirm. Yeah, 75%. 75% shares acquired will mean control, and it will lead to a parent subsidiary relationship. Even though intent is to sell within a year, there is no discount in not recording this as a subsidiary position. However, because it is being bought with the intent of selling, and it is going to be sold in the first quarter of the next financial year, which is within 1 year. And we can also see aggressive approach in order to make the sale. This meets the criteria of subsidiary brought exclusively for sale as per IFRS 5. And the presentation of the P&L and balance sheet items should happen according to IFRS 5. This means in PL, a single line item will be reported for profits from this discontinued operation. And in balance sheet, a single line item in assets as assets held for disposal under current assets, and liabilities held for disposal under current liabilities. So this is all you have to be able to justify for it. That as per consolidation, it will meet the criteria, but because it's a subsidiary exclusively bought with the idea of selling it, then yes, definitely you have to present it in the manner as per IFRS 5. It meets the criteria of IFRS 5. So presented in so and so manner. Now we're going to go to the next question, but what we'll do is we'll at least take a 10-minute break, okay, and then move to the next question. So I want you all to put a 10-minute timer. Put a 10-minute timer. Okay. So guys, use the navigator from question number 3. Come to your question number 4, which is Maputo Company. I'll read the background requirement and then we'll cater them one by one. Okay. Maputo Company operates in the shipping industry and owns vessels for transportation. The current financial year end is the 31st December 2028. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Acquisition of Bomu Company describes the accounting for the acquisition of Bomu Company. Transfer of assets to new entity provides information on the transfer of vessels to the new entity. Vessels describes the accounting for the vessels, including engine overhaul. This information should be used to answer the question requirements within the chosen response option. Now, coming to the requirement. Discuss whether the accounting treatment of the acquisition of Bomu Company is appropriate with reference to IFRS accounting standards. Your answer should consider the impact of the accounting treatment applied may have on the analysis of the consolidated financial statements by investors in Maputo Company. So first you have to say discuss whether the accounting treatment of the acquisition of Maputo is correct, appropriate or not. And second, you have to consider the impact of this accounting treatment on the consolidated financial statement. So two asks are there. Two asks. When you put it, you can like label it that okay, these are two different things. One second, I just need the name of this question. It's map. Okay. So we'll put it in a different fresh page. Accounting treatment for the acquisition. Correct or wrong in line with IFRS. And second, impact on the shareholder. Impact on the investors due to the impact of accounting treatment on the consolidated financial statements. So if you have the requirement as to what is expected very clearly written in the exam question, you can just copy paste the question. Maybe that will also work so that it's going to hammer you always that what is the requirement. Okay, and this is the requirement A1. So put A1. Now let's read what accounting treatment they have done and then judge whether it's correct or wrong in line of IFRS, in line with IFRS. Okay. In June 20x8, Maputo Company acquired Bomo Company, whose assets were entirely investments in small companies. These small companies each owned and operated one or two shipping vessels. There were no employees in BOMU company or the small companies. At the acquisition date, there were only limited activities related to the managing the small companies, as most activities were outsourced. All the personnel in BOMU company were employed by a separate management company. The companies owning the vessels had an agreement with the management company concerning assistance with chartering, purchase, and sale of vessels and any technical management. The management company used a shipbroker to assist with some of these tasks. So, if we may put it up here, you have Maputo Company, who has happened to acquire BOMU Company. Now, BOMU Company is having investments in small companies, okay? Like company A, B, C, D. And these have their shipping vessels. So they have assets, all of them shipping vessels. There were no employees in BOMO company or in the small companies. At the acquisition date, there were only limited activities related to managing, and everyone was outsourced. So, BOMO company and the small companies are actually being managed by people, but these people are not under the payroll of BOMO or these small companies. These are outside employees, outsourced employees by a management company. The company owning the vessel had an agreement with the management company concerning. Okay. Okay. So this management company is providing assistance on chartering, which means giving these vessels on rent, purchase and sale of vessels, and any technical management. So operations are existing, but they're largely being managed by they're largely being managed by an outsourced company, which is a management company. Okay. Now, Maputo Company accounted for the investment in BOMU Company as an asset acquisition in its consolidated financial statements. The consideration paid and related transaction costs were recognized as an acquisition price of the vessels. So, whatever you paid to acquire this BOMU Company, you did not do like a subsidiary accounting and you did not do a acquisition accounting. What do you mean by an acquisition accounting? Meaning to add all of the assets and liabilities line by line, to add goodwill, to add NCI, to cancel the share capital share. You did not do all of that. You just treated this acquisition like an asset acquisition, not like a subsidiary acquisition. Okay. And whatever consideration paid and related transaction, you have capitalized it with the price of the vessels. But let's say if you were going to do a subsidiary, if you were going to do a consolidation and if you were going to acquire a subsidiary, then in that case, the transaction costs incurred in acquiring the related transaction costs, they are not supposed to sit in balance sheet. They're expensed out. They are transaction costs. They are just expensed out. Okay. But this is what they did. They treated it like an asset and capitalized the transaction cost. Now, Maputo Company argued that the vessels were only passive investments and that Mobu Company did not own a business consisting of processes, since all activities regarding commercial and technical management were outsourced to the management company. As a result, the acquisition was accounted for as if vessels were acquired on a standalone basis. Their justification for treating it like an asset acquisition is that they are saying that the personnel, the staff, is not on the payroll of uh, BOMO company. It is under the payroll of some third party, and that and these are third party services. So that's why they're saying that actually this business does not consist of processes and any activities. They are being done by the third party. So I want you all to think about this and tell me that whether their justification is right or not. Again, I'll just quickly do this. You have Maputo Company in picture. Maputo Company acquired BOMU Company. BOMU Company has further small companies A, B, C, D, E, and whatnot, and they all have vessels. They all own vessels, one or two vessels, they all own it. Okay. Now, for this, buy and sell operations are taking place. Okay, chartering operations are taking place. So, because it's into a transportation, everything is taking place. Okay, buy, sell, chartering, maintaining, everything is taking place. All the operations or activities are taking place. It's just that it's being managed by third party. It's being managed by a third party. So you're paying a third party to manage this. The people also are working on it. People are also working on the ship. They are also working to manage, but these people are under the payroll of third party. Now, is Mapito's judgment correct that Bomu company does not have any processes because everything is outsourced? So that's why it's not a business acquisition, but it's an asset acquisition. It's not a business asset acquisition, it's an acquisition. Is this thing correct or wrong? Is this judgment right or wrong? Does IFRS 3 or IF business combinations or IFRS 10 consolidated financial statement give you that leeway that, okay, because the operations are being handled by a third party, it's not a business? Yeah, they acquired the whole company, not just vessels. And yeah, I know concentration test means if the entire worth of the company is shrunken in just those particular assets. But you can see that there are operations, and even if the operations are outsourced, operations are happening. So this is a proper acquisition of a company only. It's not an acquisition of just merely an asset. There are inputs. There are inputs in Bomu company. For us, for Maputo company, Bomu company's input would be what? Our shares in the Bomu company shares in A, B, C, D, small entities. This is one of the input. The contracts with management company, this is the other input. The contracts of chartering, giving it on lease, this is another input. What are the operations? Being able to maintain those ships, being able to give it for chartering. Okay, those are the operations. Even if managed by the third company, they are operations. What would be the output? Revenue would be the output. When you buy and sell, there is a profit on disposal. Those are the outputs. So there is proper input, processes, and output. Everything pretty much is evident. Even if managed by third party, everything is evident. So this should not be treated like an acquisition of asset, but should be treated like an acquisition of a subsidiary with full acquisition accounting, which means there should be goodwill coming in picture. There should be transaction cost should be expense and should not go and sit with the asset in the balance sheet. Fair value assessment of the asset should take place at the acquisition date. If there is a difference between the carrying value and the fair value of the asset, then you have to take the fair value and there'll be a deferred tax liability coming on this. If the value of the assets are increasing, there'll be a higher depreciation, so profits will get lower. Why am I thinking of the impacts? Because they did ask us, how is this going to impact the investors? Yeah, they acquired the whole company. That's the kind of indication we are getting. They're not talking about any percentage. Okay, they're not talking about any percentage. Okay. The treatment for Bomu company merely as an asset acquisition seems to be incorrect. Okay. Now, for in order, or just one second, let me just see. Well, it seems to be incorrect. Bomu company is actually a business that is being acquired, and this required acquisition accounting. We can see that Bomu company, okay, also for an entity to qualify as a business, it should have an integrated set of activities with assets which can be managed and which give returns or save costs, etc. The business would have input, processes, and output. We can see that, why is it picking red color? Very weird. We can see that the investments in the small companies, which is giving control on the vessels, would be inputs. The arrangements or contracts, the contracts for chartering and with management company will act as inputs again. The process of chartering, buying and selling, maintenance of the vessels, will be the processes. The outputs would be the revenue generated from chartering the vehicles, from chartering the vessels, and the profit from disposals. In the presence of, let me just make this one paragraph. In the presence of all the three elements, MOBU will act as a business, not a asset. Also, the justification provided by Maputo for treating this as asset is that all the personals are outsourced. However, this is not valid. This is not a valid justification, because if they were not outsourced, then Maputo company would have to figure to continue to perform the operations in-house personals. Therefore, outsource cannot be the deciding factor. Now, how is this going to affect the investors, right? When an entity, or let me see. So it's incorrect, and I'll also give the right correct accounting treatment. As this was to be accounted as subsidiary acquisition, it was required that goodwill should have been recorded for the premium paid to acquire. Assets should have been recorded at fair value with DTL for any increase in fair value, higher depreciation for increase in the value of assets, and line by line adding of assets and liabilities. So now the impact on investors. Also, transaction weight, transaction expense should have been, transaction cost should have been expense to P&L. Due to incorrect accounting, this will impact the shareholders as they will not be able to judge the financial statements correctly. As the assets are not recorded at fair value, they are understated. Also, depreciation recording is less. Therefore, profits are overstated. Transaction expense have not been recorded in P&L. Therefore, profits again are overstated. The assets detail has been missed to record. Therefore, liabilities are understated. Eventually, goodwill will not be recorded, would have not been recorded. Therefore, assets again understated. Eventually, many items will be misstated, leading to investors' concern on the accurate reporting of financial statements. If it's treated as asset acquisition, wouldn't it be overstated? Okay, assets could be, I will not say that, because what will happen is when you're going to record for it as a subsidiary accounting, also line by line, you're going to add the assets, no? So those assets will also come in picture, right? Those vessels will come in picture in the consolidated financial statements. Revenue. What impact could it be there on revenue? Yes, revenue, of course, you're absolutely correct. Revenue will be understated because the revenue from BOMO company earned by chartering might not come in picture in the consolidated financial statements. So business concentration test you should guys ideally use if like the three input output and this is you're not able to see input process and output, then just go for a business concentration. But just using business concentration independently to judge wouldn't be the right thing, because in this case if you can see input process output is there, and from a business concentration perspective it might pass because you just have vessels, probably one category, but you can see input process output. So don't check for business concentration if input process and output is present. Okay, in that case don't do it. But let's say input process output is missing, then do a second check on business concentration. Okay, so now we're going to move to the next requirement. Okay. Discuss whether the directors of Maputo Company were correct to consider the new entity a subsidiary of the bank and so de-recognize the transferred vessels. Okay. Maputo Company had borrowed heavily to purchase some vessels and was struggling to meet its debt obligations. Maputo Company had some of these vessels, but in some cases, the bank did not wish Maputo Company to sell the vessel. In these cases, the vessel was transferred to a new entity in which the bank retained a variable interest based on the level of indebtedness. Maputo Company's directors believe that the entity is a subsidiary of the bank. The directors have treated the transfer as disposals, although Maputo Company continues to use the vessel in the day-to-day operations. So it's simple. Let me just paint the picture here, what it is. This is Maputo Company's books. Okay, it has vessels. Because it's facing liquidity issue, it started to sell. For some, the bank said don't sell. So it transferred to another entity, any entity, it's just transferred to another entity called Z Company. Okay. From here, it got transferred at or let me just. From here, it got transferred and went to the Z Company. Okay. Now, in this Z Company, because Maputo is the creator or the initiator for this, of course, Maputo will have shares, but also there is a bank to whom it had whom it had borrowed shares, also owns shares in the Z Company. Okay, has shares or ownership of Z Company. So on paper from Maputo's books, it's out. On paper from Maputo's books, it's out. But Maputo is still making use of these vessels. It's still using it. It's still using it. Okay, let me put it in this way. That even though from a book's perspective, it's out, but it's still using it. Okay, from books, it's out, but it's still using it. Now, I want you all to think and tell me that was Maputo right to remove it from the books in the first place just because of legal paper, from a legal paper ownership it transferred to Z Company? Was it right to remove from its books and record a gain on it? So I just have one person answering. Marsha is saying no. What about others? Why do you think it's no? Give me a valid reason. Why do you think it's no? Substance over form. Absolutely correct. Substance over form. In form, it's probably with Z Company, but in substance, Maputo is still using it, still making use of it. So what has happened is probably, if you all may recall your IFRS 16, where you would sell it and lease back. So in sale and lease back, you had to identify whether the transfer was an actual transfer, whether it was an actual sale or not an actual sale. So this is a transfer, but not an actual sale, because you don't have to remove it from your books, because in essence you still own them, in essence you are still using it. It's just the way bank has made this look like is it's probably out for bank, it's probably out of Maputo's books, but probably bank has this just as a collateral. This bank has just as a collateral. Okay, so it should look like a sale and lease back, meaning like a loan arrangement, like a financing arrangement, and should not de-recognize. So what is Maputo's directors believing? Maputo's directors believing the entity is a subsidiary of the bank, and the directors have treated the transfer as disposals, although Maputo Company continues to use the vessels in day-to-day operations. Now, if Maputo companies believe that the entity is a subsidiary of bank, in order for an entity to be a subsidiary of any other entity, what it should have? It should have control. And how do you have control? If you have power, exposure, ability to exercise the power. So bank can have it as a subsidiary if this three is met. But I can't evidently see from the scenario that these three are being met for bank. So it might not be a subsidiary. Also for the derecognition, we have to challenge it because it doesn't seem that control is lost. Maputo is still very much using it. It could be like a sale and leaseback arrangement without the actual sale. So let's put it in words. So Maputo company has transferred the vessel to a third entity in which the bank has certain shares based on the level of debt. Maputo's directors believe this entity is a subsidiary of bank. As per IFRS, in order for an entity to be a subsidiary, parent should have control over it. Control can be determined if parent has power, ability to exercise the power, and rights or exposure over the variable returns of the entity. From the scenario, it is not evident whether bank exerts such kind of control. Therefore, call, therefore, to say this entity is a subsidiary of bank might not be correct. Okay. Also, Maputo has de-recognized the assets, the vessels from its books. This might not be the accurate accounting treatment, as Maputo company is still using them and should account for it basis substance over form, even though on paper this might be with third entity. Therefore, Maputo should reverse the disposal entries and bring the asset back in the books. This would be more like a sale and lease back where the transfer does not meet the criteria of sale as per IFRS 15. The loan element must already be recorded as a liability with the bank. Therefore, it might not be re-recorded. So I answered both. Even the new entity, I discussed that why it is correct or not correct, talking about the P power exposure, ability to exercise the power, and the D recognition also I called it wrong because of IFRS 16's lease and sale and lease back. We know such scenario exists where on paper it will look like a sale, but it's not actually a sale. So in that case, it should be there. The asset should be there with the entity, and only a loan element should be recorded. So I have answered it in that light as well. Now the final requirement for the day. Discuss the accounting treatment of the vessels in the financial statements of Maputo Company. Accounting treatment of the vessels. So let's read now what we have for vessels. Like this was really, I think, too much to read. And then it just had 8 marks. Again, I feel like till here, it would be difficult to reach till the final stage and write a detailed answer. You could have written little here and there, not a lot, because again, like I said, this is the last bit, the last requirement. You wouldn't have a lot of time. Plus, not so much, leisure to think about these standards, exact requirement, and apply it. So whatever you could recall with that little time, you should have written it. Trying to make sure that even if you're not getting the 8 mark, at least you're getting a 4 mark here. At least you're getting a 4 mark here. Okay. Now they're asking us on the treatment, right? So we'll read the treatment for the vessels. Vessels are a major class of Maputo companies' total assets. Till now, we know this because vessels is the major way in which they are making their revenue. The economic life of the vessels is estimated to be 30 years, but the useful life of some vessels is only 10 years because Maputo companies' policy is to sell these vessels when they are 10 years old. So, economic life 30 years, meaning if you happen to really use them, they'll run for 30 years. But some vessels are only having a 10 years life in Maputo's books because it will sell it off in 10 years. It will not retain it more than 10 years. So Maputo company estimated the residual value of these vessels at the sale to be half of acquisition cost, and this value was assumed to be constant during the useful life. See, I want you all to recall when you're going to assess the assets cost and the depreciation, what do? Let's say, for example, you have an asset at a cost of 100 million, okay? And then you have a residual value estimated for it as 20 million. So when you are finding a depreciation, you may recall that you will take 100 less 20 and then do a depreciation. So I have 80. Now my life is 8 years. So it will just come as 10 million depreciation per year. Okay. I will remove the residual value and then do a depreciation calculation because I will not depreciate that amount that any which ways I'm going to get by selling. Now, what they are saying is that they have fixated a policy. They have for vessels which they sell within 10 years, right? Because this vessels which they sell within 10 years, you know that you have not used it to the full life. So if 20-year life is still remaining, the residual value would naturally be very high. It will not be like a scrap sale. So what they have done is they have kept a very standard policy that the residual value for these vessels will be half of the acquisition cost. And it will be constant from the first year to the 10th year. It will be constant only. It will not change, they are saying. This is going to be half only. Now, ideally, what should residual value be? That at the time of disposal of that vessel, whatever you're going to fetch in reality at that point of time, the most realistic estimate you'll try to make of that. And based on that condition, so at the 10th year, whatever is the condition of that vessel, estimating the condition, what value you will get, that will be the residual value. And these guys are not considering that. They're saying half of the historical cost. And this is going to even remain constant. So ideally, what should have happened? First year, you have some residual value. Second year, when you reassess the residual value, third year, fourth year, fifth year, it will be more closer to the reality. It will be more closer to the reality because of the changing estimates. Okay. Now, Maputo company argued that the estimates for the residual value used were conservative in view of an immature market with a high degree of uncertainty and presented documentation which indicated some vessels were being sold for a price considerably above carrying amount. Broker valuations of the residual value were considerably higher than those used by Maputo. Maputo argued against broker valuations on the grounds that it would result in greater volatility in reporting. Now, I want you all to think and tell me that residual value estimation, should it be fixated? Should it be residual value? especially for these assets, vessels which he's going to sell within 10 years, should it be fixated to the 50% of historical cost, or should it reflect the reality? So should you take some broker calculations and those reality should reflect in residual value? Should you take a fixated value or something which third party is going to help you calculate? What would be the more better estimate? I want the input from you all. Should I take a fixated approach or something which is going to be calculated by a broker considering what the real value would be in the market? Professional advice from brokers, right? This would be the more appropriate approach, not something fixated. So from a third party who are expert in this calculation, you should have taken the residual value calculation from them. They would have considered the market value considerations and then they would have given you a value. You should have considered that. Second, should it have remained constant? Should it remained constant throughout the 10 years? Or you should have revalued it at every year end, the residual value revalue at every year end. Any idea what is the right approach for this estimate? Because residual value is an estimate. You have to actually revalue at every year and you can't have a constant 10-year policy. You can't have a constant 10-year same policy. You should ideally revalue. So two places he has gone wrong. They have taken a fixated approach of 50% of historical cost, leaving a third party more professional valuation. And then they kept it constant for 10 years, leaving the revaluation policy of checking the residual value every year. Okay. Now, the argument is what? That taking the broker's valuation will lead to greater volatility in reporting. Of course, this is effort. This is a hassle that every year, let's say a broker's valuation is getting changed, then of course there'll be volatility in reporting. But I don't think there are any such relaxation given that because of volatility in reporting, you need not do what the professional you need not take the professional estimate and have a fixed policy approach of 50% of it. That is not allowed. So we will call this out. We will call this out. Then it's starting and saying Maputo company keeps some of the vessels for 30 whole years. So it's starting with another scenario where it's going to keep some vessels for the whole of the 30 years. But before we reach that, let's finish the accounting, what they have done for vessels which they just keep for 10 years, right? Let's talk about that. So requirement was discuss the accounting treatment for the vessels, right? And this is requirement B only. Vessels sold on the 10th year. So Maputo company has certain vessels, has vessels with economic life of 30 years. However, certain vessels it uses only for 10 years and then disposes them off. Maputo company has decided on a policy for its residual value calculation. It has frozen the residual value to be at 50% of the historical cost throughout the 10-year period. Even though there are professional brokers who are giving the right estimation or who are giving more accurate estimation of the residual value, Maputo company is ignoring it, stating that depending on broker would lead to high volatility in reporting. However, IFRS is not giving this exception where if there is volatility, it can escape from doing the accurate estimation or closer to accurate estimation. Therefore, Maputo company's approach is incorrect. It should also not have a stable residual value for the purpose of ease, and should continue to revalue it at every year end. Also, the estimate that has been calculated by the brokers for residual value seems higher than what Maputo is recording. If the residual value exceeds the carrying value at any given point of time, then the depreciation will become nil and should be accounted accordingly. So vessel sold on the 10th year. Now I'm not going to overwrite it. I'll stop here for this particular piece and then move to the next paragraph. Maputo company keeps some vessels for 30 years, and these vessels are required to undergo an engine overhaul in dry dock every 10 years to restore their service potential. Hence, the reason why some of the vessels are sold. The residual value of the vessels kept for 30 years is based on the steel value of the vessel at the end of its economic life. Now, for the vessels which it's going to keep for 30 years, it's saying the scrap value or the residual value will be based on the steel valuation, the scrap value for steel. Does this seem like a right approach where they're saying that whatever steel value will remain at the end of 30 years, that would be the residual value? Is this the right approach? Unlike the previous scenario, we saw 50% of historical cost, that was the approach. In this case, is this the right approach? Whatever will be the residual value of steel? Okay, Shamal is saying wrong. Shamal is saying wrong. What about others? Fungi is saying yes. What about others? Do you think it's right or wrong to have a residual value estimation based on the steel value that will remain of for the ship at the end? Yes, it's valid. No, see, because if you are using the entire ship's life, 30 years, economic life fully finished, what remains in the ship is the steel, the scrap. So that seems to be a correct valuation. At the time of purchase, the service potential which will be required to restore by the engine overall is measured on the cost as if it had been performed at the time of the purchase of the vessel. In the current period, one of the vessels had to have the engine totally replaced only after 8 years. So the other things that you have to take care of is that these vehicles that you're keeping for 30 years, okay, it has to, for its engine, undergo overhauls every 10 years, which means some major repairs it has to undergo for every 10 years. I want you all to think and tell me from IS 16, whatever you remember, that when you have a major overhaul or a major repair, how do you treat this major overhaul or repair? How do you treat it? you capitalize, because this is not going to happen every year. It's not like a repair maintenance. It's going to happen once in 5 years. And that one repair of that you made in 5 years will sustain for the next 5 years. The one repair made for the 10 years will sustain for the 10 years, right? So one time you've spent money, but it's going to sustain for the next 10 years. So it can't be expense. Then it has to get capitalized with the cost of the asset and has to get depreciated every 10 years. In the 10 years, then it will be treated as an expense by depreciation form. If there is a major repair, major systematic repair, which is called overhauls, which will happen for aircrafts or vessels like these, then you have to capitalize them and write them off in the P&L in the form of depreciation. You can't do a one-off recording in the P&L because benefit is for 10 years. Okay. So this is what is the accounting treatment that you have to suggest, that every 10 years, whenever you're doing a major overhaul, that's amount that is being spent will be capitalized and depreciation will be recorded for the 10 years for that particular engine. Okay. Now they're talking about one such vessel which had to have a replacement in 8 years itself. In 8 years itself. So before you touch the 10-year life, you had to, in the period of 8 year itself, undergo a overhaul. So normally you have a life of 10 years. So let's say it's costing you 10 million. One overhaul is for one particular part of engine. One per part is costing you 10 million. Okay. Or let's say 1 million to keep it more realistic. 1 million. Okay. So you know that it is 100 million, 100,000 per year. Now, at the 8th year itself, in the book, when the carrying value of this particular engine is going to be 200,000. Why I'm saying 200,000? Because it must be 1 million, remove the depreciation for 8 years, 200,000 is remaining, right? So this is the carrying value, 200,000. So at this point, if this was completely damaged, then what do? Can you all suggest the right accounting treatment that at the 8th year, when there was one part which has a carrying value of 200,000, was completely damaged and needed to be replaced? What is the accounting treatment that you'll pass for this particular engine? Can you all put in the chat box? Can you all think through this? Put in the chat box. What is the accounting treatment required? Yeah, you will have to completely write off this 200,000, which is right, impair it. Remove this 200,000 entirely from your books. This value is at zero now. And now whatever you're spending for the overall, again, that fresh 1 million, capitalize it and then start writing it off. Okay, so this is the accounting treatment that you have to suggest for that one particular engine. So two engines in question, one which is going to have 10-year life and the other which is going to have 8-year life, and the other that is residual value approach of using scrap value of in steel. Three things we'll have to talk about. Okay, so we'll do that. Vessel sold on the 30th year. The residual value considered for vessels sold in the 30th year is the steel value. This seems to be a correct approach by Maputo Company, where steel price will be the scrap value for the vessel whose economic life is completely over. The vessel seems to be a complex asset in nature, which means it has parts with their independent economic life. In case of engines, it has a life of 10 years and requires overhaul after every 10 years. In this case, the vessel's parts should be identified initially with different useful lives, and depreciation per part should take place where the life is different. In case of engines, the depreciation will be basis the tenure overall cycle. At the time of overall, the amount spent will be capitalized for the overall and then depreciated for 10 years. However, one individual vessel where overhaul had to be performed in the 8th year, in this case, there still will be certain carrying value remaining for the engine. This needs to be written off, and the new overall amount should be capitalized. Sorry. Now, coming to the scenario again, there was one final thing that we did not read. It said that normally engines last for the 30-year economic life if overhauled every 10 years. Additionally, one type of vessel was having its funnels replaced after 15 years, but the funnels had not been depreciated separately. So, if there is funnels which has a separate life of 15 years, this was also to be identified at the beginning of the year. But if it's not been identified at the beginning of the year, then when that when it has been identified, it should be identified that okay, what the carrying value of funnel should be, considering that it must have been written off basis the 15-year, and then remove it from your books when the life will end, and then replace it with the fresh cost and capitalize it. Okay, so this is the accounting treatment we'll suggest for funnel. Funnel is the other component of vessel which has its own independent life of 15 years. In this case, from the initial recognition, funnel should have been recognized as a separate component and depreciated separately. As this was not identified, then the carrying value of the funnel basis if it was correctly depreciated should be identified, and at the time of replacement, the new value should be capitalized with any remaining carrying value to be de-recognized from the books. Okay, so yeah, it was like it's the last requirement, but in that one requirement B itself, they asked us like 3 accounting scenarios further. So independently, it's not difficult, but because it's so much quantity, like A1 has its own issues, A2 has its own issues, then B has further 3 issues in itself. Because of the quantity, this becomes challenging. More than the treatment, identifying the treatment, it's the challenge here is really the, I would say, time and the number of scenarios they have tried to fit in this. Okay. So yes, this is how, guys, you have to break the requirement of every question and then cater it one by one, not take everything together. So Harish, one thing that I will say is that when you read a requirement, now I could not copy it in Word because you can't copy anything from the portal to Word, but copy the question from here to your word processor and break the requirement. So if they are asking you one thing, then break it if you very clearly know what they're asking. Okay. So for example, in my final requirement, what they were asking me is the treatment of the vessels. So in the treatment of the vessels, when I was reading, as in when I was reading, I was identifying, oh, that there are many issues on the vessels, not just one accounting issue that I have to discuss. So whenever you're reading the scenario, keep breaking the scenarios, give some subheadings or subtitles. So you know that every scenario you're catering, you are able to validate that you're catering it. Okay. The other key thing is that remember that the question requirement should be very clear in your head. If the question requirement is not clear in your head, you will not be able to pick point from the scenario and draft the answer. So read it one time, two time, three time, till the time you are not very clear with what the requirement is. Okay. And having it right in front of your eye is the best thing, to have it in your word processor right in front of you. Now, if you may have seen the questions that I have cracked yesterday and today, I have highly banked on the application approach rather than state, apply, conclude approach. It is a application. If you can do this application approach rather than state and apply and conclude framework, it's better because continuously you're able to grab marks and close it. Someone who lacks in just directly starting from application needs a framework, needs a guidance there, can do a state, apply, conclude. That is, think from which standard it is coming and state the principle of that standard, what the standard says. There are marks for quoting principle. It's not that there are no marks for quoting principles. So you quote the principle, then apply, and then finish off the answer. Sometimes, Harish, there is also option that that answer could be tackled from various standards perspective, or you could have spoken about one standard in detail rather than the other standard. So sometimes it's not confusion; it's a valid thing that you are literally having an option to answer, give variety of answers. So it's, if you see my answer and your answer not matching, your answer and the answer in the study hub not matching, it's because that variety is allowed. If you are able to quote the right standard and give the right suggestion, even if it doesn't match with the what has been written by the examiner, it's okay. Sometimes it's not matching because it's actually wrong. You have gotten confused and you have started to attack those part of the standard which were not directly connected with the scenario. So where you can get off guard is that maybe, let's say for example, the standard is talking about subsequent treatment of a particular thing, like over here subsequent treatment overalls replacement was a very specific thing. Now if over here I start talking about subsequent treatment cost model, revaluation model, that's off guard. It's not required. If I identify, oh, this is subsequent measurement of an IS16 item, let me talk about revaluation and cost model in the principle, it will fetch me 0 mark. It's not connected to the scenario. What is connected to the scenario is the overall, the replacement, that subsequently when you make a spending on enhancement of the asset, or it's a overall, or if it's a replacement of a complex part, then you're allowed to capitalize these. So talking about that would fetch mark, not revaluation and cost model. So yeah, you need to be able to think very clearly that which part of the standard is this related to. Okay. So yes, guys, with this, we come to an end to today's session. Even before the next week, during this week itself, you'll have a 50-mark mock. So tomorrow itself, you'll have a practice, one more practice session of which is the 7th class. Day after tomorrow, you have a 50-mark mock. 50-mark mock, when you crack day after tomorrow, the debrief of that 50-mark mock, I will be giving day after tomorrow itself. You might see a date like this. I'll just show you the calendar. You might see that tomorrow is the 7th practice session, which is fine. 11th, you will see a 50-mark mock, and 12th, you will see a mock debrief. No, 12th, I have to urgently travel for a medical emergency in my family. So I have to travel out of the country. So 11th only, I will take the 50-mark mock. and 11th only I will take the 50 mark debrief. Now, someone for whom 11th is a working day can't take the 50 mark mock, can't attend the 50 mark debrief. No problem. It is designed to be on the weekdays because we have to take it before the previous weekend for any, not just my class. For any other class, it's designed to be in the weekday only. Okay, we can't push it till the weekend because we have now other things to cover on the weekend, which is the grand revision and the 100 mark mock. So we have to get done with this on the 11th itself. So if you are a working student and cannot watch it, you can just go and watch it at your own pace anytime before the exam later. That 50 mark is just merely practice. It's just merely practice. You can do that 50 mark mock later whenever and watch the debrief whenever you have the time. Okay. So this is the plan. 10th is the 7th class, 11th is the 50 mark mock with the debrief, 16th is the grand revision, and 23rd will be the 100 mark mock with another 100 mark debrief in this weekend itself, this Friday, Saturday weekend itself. Okay. So yes, guys, see you all tomorrow with the 7th practice session. Not a long goodbye, a very short goodbye. Thank you. Have a good weekend. Bye-bye.